What is the business plan that you're investing in? And what is the operator? Like, there's so many things that if you don't understand, you are literally just throwing money and hoping for the best. And hope, just like in Wall Street, is not a strategy.
Trav, let me ask you a question. Have you tried to figure out how can you work more and earn less? No, that's the opposite of what we want to do. We want to work less and earn more. Today, we're going to break down Syndications 101 of how that we can put our money to work for us and have more earnings while we hopefully start to work less over time. But we're going to also try to determine, is this truly a passive strategy, or do we need to be active on the front end? I'm Russ Morgan. I'm one of your hosts today. I'm joined by Joey Murray, Ben Busick, and Mark Haraguchi. We're going to try to tackle the strategy so not only you know what a syndication is and how it works, but also how do you mitigate risk and vet a syndication deal so that maybe you do get to earn money. You're not chasing them. And then what should someone do next? So we'll use our experience around this. So first, guys, let me ask you this question. Why do most business owners and high income earners struggle to build passive income that actually works? Mark, do you see a big challenge here that they need to consider? What's on the horizon for them?
I'd say the common theme that I come across is time. Right? They're focused on a specific area, be it their business or their profession. All that focus is on trading of their time and energy into active income. But when the shop closes or they clock out, they're no longer generating income or cash. So I was shopping the other day, and my wife and I were down in Portland, and we were taking a look for a new mattress. And as we're talking to the shop owner, he goes, "Yeah, we're really shorthanded today because the owner had to drive 3 hours north to Seattle to open up their shop there because everybody who was supposed to run that shop was out sick."
Ooh.
So there's a guy who clearly does not have control of time. He is tied and married to the business. He's working in it as opposed to on it. So time is going to be my first vote on this.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to what'swhatwallstreet.com/PIOS. Joey, what's one of the biggest misconceptions about building passive income?
And Russ, I think the real biggest misconception is passive income has to be active before it's passive. Everything, write this down, everything is active before it's passive. When it comes to putting money into syndication, it sounds super simple. It sounds like, hey, I just write a check and I move on. But if you don't realize that you have to be the investor first, that means you've had to put in hours of time to understand the deal, how to structure deals, what sort of collateral is being used, what is the business plan that you're investing in, and what is the operator. Like, there's so many things that if you don't understand, you are literally just throwing money and hoping for the best. And hope, just like in Wall Street, is not a strategy, or at least it's not a wise strategy. So active before you're passive. That's what my biggest misconception.
Ben, you spend a lot of time with people who have set up their passive income operating system, and now they move to this now what, right? Like, I want to start building passive income. I need to take this cash value that I've created now in my infinite banking concept, and I want to put it to work, but I don't know what to do. In your opinion, why do so many investors overlook syndications as a possible passive income stream?
Great question. And thanks for having me back on the show. Simply stated, I think it's because they just don't understand it. There's new terminology that we think about, like GPs or general partners, LPs or limited partners. Generally speaking, I think in what we're talking about in this podcast, we're going to refer specifically to LPs, limited partners. But holistically, most people hear the word syndication and they think it's either too complex or it's just for ultra wealthy people. But in reality, it's just an easy way to get into real estate without having to be a landlord or manage properties yourself. I remember first getting into multifamily syndications 2017, 2018 timeframe. And I went to a seminar in Dallas that was supposed to be nothing but multifamily real estate syndicators. And I showed up there thinking that maybe I don't belong here. This is out of my league. I should not be here. I had a few single family rentals at the time. But what I come to realize is most people inside of that room didn't even have single family rentals. They were just there trying to figure out what to do, educate themselves maybe, but they weren't taking action. And that's why I think this is a great strategy for us to talk about today.
All right. No, I want to talk about what is a syndication, because there's people that are listening to the podcast and maybe this is a new term. I think most of our listeners are pretty educated in this, but just in case, I don't want anybody to be left behind. Mark, if somebody's never heard about this before, could you explain it to them in simple terms?
I would say that in my mind's eye, a syndication, it's a group investment where multiple investors get to pool their money to get into a deal that they otherwise couldn't afford, right? So think of, as you're driving around town, there's a huge rental complex. There's no way that you would probably have the bankroll to set that thing up on your own. If you do, please send me an email, mark@strategicibc.com. Would love to talk to you and kind of hear what's going on in your world. Shameless plug there. But for most of us, that's just too big of a nut to try to crack on our own. Well, if I can get into that deal leveraging a group, so that now instead of me trying to come up with all the funds, now there's maybe 10, 15, 20 of us, we can go in. What are we doing? We're spreading risk. We're mitigating our individual risk because I now have a smaller slice that's having to go into it. So it's a way to get into some of these deals where now all of a sudden you have a group and a pool. There's some structure, like what Ben was saying. There's limited partners, there's general partners. But ultimately, in my opinion, it's a way to mitigate risk.
Ryan, my 12-year-old son's like totally interested in spending every single minute he has outdoors. And right now he's dead set on building like this tree house up on our hill. And I'm trying to figure out, one, who's going to engineer this thing so it doesn't fall off the hill, right? Out of the tree, off the hill, somebody's hurt. And then secondly, like, how are we going to pay for this? So like if I was describing a syndication to him, I'd be like, hey, you know that tree house you want to build? The one that you really want to build is like the one that you see on, what is that, Treehouse Hunters, or what's that show that
Swiss Family Robinson.
Wrong show, Joey. The guys from like the Seattle area. Anyway, he builds like these dream mansion tree houses. I think that's probably what you're really thinking in your head as he starts describing all the drawbridges and the secret trap doors and the attic in it. And I'm like, what we're going to need to do then is that we're going to need to maybe pool a bunch of money together from a bunch of kids in the neighborhood and get them to chime in on this deal. And then now we get our treehouse. Well, that's kind of what a syndication is. And if we decide we want to rent it out to other kids to come play in it, that's how we all profit. Well, like you said, Mark, a big apartment complex is just a big treehouse, if you will, where one person didn't pay for it. A bunch of people decided to join in, and then they started renting it to other people. All right. Now, Joey, for busy professionals, people who are thinking about this, why is this different than buying just, say, a solo single-family home property on their own?
Well, and for a lot of the same reasons that Mark mentioned is it's actually taking on less risk because you're not the sole person involved in the transaction. So if you're buying a just single family rental, you're responsible for finding the property. You're responsible for the tenants, managing them, getting them in, getting them out, handling maintenance, dealing with all the financing. And to your point, again, the sheer volume of the capacity of the capital involved in the transaction is all on you. Whereas in a syndication, you're now able to leverage that group. You're able to simply invest. And now you've got an operator who, again, you have to do your due diligence on, is doing all the heavy lifting. You're simply a financial contributor and you get returns when the whole thing wins, right? So comes from the rental income, comes from appreciation and any sort of tax advantages that are involved in the business plan. So that's what I would say is, like, if you're trying to kind of compartmentalize this as to how this is different, those are some of the key factors to consider.
No, that's good. Ben, what type of returns are you seeing investors expectations around syndications, right? I know it's hard to know what one will actually return, but what is the typical expectation of a syndication that whenever you're looking at this and talking about it with your clients?
Yeah, it's tricky, right? In some circles, especially the multifamily place at the time of this recording, the expectation might be, I don't want to lose my initial capital. I don't want a cash call. But all joking aside, as a whole, and when we're talking about syndications, it's not just apartment buildings or storage units. You can syndicate all kinds of different stuff. But I would say, typically speaking, from a cash flow distribution, you're looking at 6, 8, 10, 12% a year. Depending on the type of syndication and the deal that you're looking at. That would be on an annual basis, but over the whole course of the investment, you might be 15, 25% over the life of the deal. Some other things to consider are not just the cash flow or the return of your investment, but the syndications typically offer tax benefits like depreciation. Again, at the time of this recording, there's bonus depreciation. And then there's strategies associated with this, like cost segregation, where a bunch of smart people rapidly depreciate the asset because instead of holding it for 28, 9, 30 years, you're only holding it for a smaller period of time. And so they're able to utilize that strategy up front to make the returns even better. Probably my worst apartment syndication deal. The expectation there was it was going to be a 2.01 multiplier, meaning like if I put 50K in, I was going to get over 100K back. It was going to be great. But what actually happened was that was more like a 1.1 multiple. It was a 10% over the life of almost 4 years. And so all that's basically turned into, I was making about $200 a month on my money over the course of 4 years. So that was my worst deal. Everybody's mileage may vary, but that's maybe helpful to the audience.
Well, what I would say, and I know we're going to kind of get into the next part, which is how do you mitigate risk and vet syndications specifically. What I would caution everyone as you go into this is that was a loaded question. Thank you for answering it as diplomatically as you did. But I would say don't expect a syndication to do anything. Like, don't go with this expectation that it's going to produce this imaginary return. You need to figure out what benefit is it adding to the world, and why is it that you're required to participate in it? If it's so good, why you need me? Right? Like, there's the question that you need to be asking as we get into risk and thinking through how do we mitigate risk. You need to say, why is this deal out there? What are the real opportunities? What are the returns? And I've seen deals where people lost, all their money, right? I've seen deals where people lost half their money. I've seen people where they've doubled their money. And I don't think that there is a return profile. Most of the people who put together syndications are going to do it with an expectation in mind that, hey, if I can earn 15 to 20% over the life of this project, I can get a percentage of that. I can give the rest to people who help me get there. That's where they start off with. But what risk exists that will prevent them from being able to achieve those results? That's what we need to dig into, Stallion. So there is no guaranteed investment. So Mark, what are some of the biggest risks investors should watch out for when they're looking into syndications?
The operator. There are huge risks involved in, especially if you don't know the operator. I have heard several investors bring this up and they say, I'm not going to invest with anyone who hasn't seen a 2008 type economic downturn. Because a lot of people were pitching a lot of these deals, and I'm getting to the operator, I'm going to come back to that, but they were pitching these deals and they were coming from a historical time frame of running stuff from, say, 2014, 15, 16 through 18. And so they've known an upward trajectory. It would be no different than Russ being the oracle of financial retirement investment in the lead up to 2008. And then 2008 revealed that there was nothing underneath his Swami hat. So, I mean, aside from going on Amazon right now and getting a magic 8-ball to vet your deal, you really should take a look at the operator. Who are they? How long have they been around? What types of events have they seen? What type of events have they gone through? And asking those hard questions, is the deal over leveraged? Are we too optimistic in what we think? I have a deal from 2018 that has paid me a sum total 0. Absolutely nothing since 2018. So what went wrong? Well, market forces. These guys weren't exactly positioned the right way. Did I do a proper vetting schedule? I'll be the first to say that no, I did not. At that time, my vetting was, wow, that sounds really cool. Wow, show me your shiny little packet. And oh my gosh, why would your delivery, your webinar be anything other than how awesome this deal is? So asking around, finding other people who've done these types of deals. Vetting is probably one of the most important things you could do. It's crucial. So that would be my piece on that.
One of the things that my investor DNA profile gets caught up in is like shiny object syndrome. I am that very like, show me something. If I can believe in its purpose, if I can see the opportunity, and if it seems fun, I'm in, right? Like I have to be cautious to not just go with my gut, right? Because sometimes as entrepreneurs, investors, we tend to just lead with our gut. So a friend of ours likes to say, if a deal seems like a no-brainer, get a second opinion. And probably don't get a second opinion from somebody just like you, because gut may be telling them the same thing.
There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Tribe, if you're still searching for what is going to be that passive income source that's going to push you over the hump, it's going to help you become financially free, head over to the Art of Passive Income podcast, where our friend Mark Podolsky breaks down his amazing land flipping method.
You've heard us talk about how this one strategy has created over $30,000 a month in passive income for Russ and I. Do yourself a favor, wherever you listen to podcasts, go hit the subscribe button to the Art of Passive Income podcast today.
Joey, speaking of operators, we've had our run-in with operators in the past. What are some of those red flags someone should look out for in an operator?
Great question, Russ. And to your point, Mark, thank you for pointing out that's one of the biggest risks in the deal. And I would say that you have to be willing to ask the hard questions. And to your point, Russ, from an investor DNA standpoint, if you're highly social and you're highly influenceable, or you like being a people pleaser, if you will, this is going to be one of the hardest things for you to do in any deal, is to ask hard questions of somebody who, from all appearances, is knowledgeable. And maybe you don't have that much knowledge. One of the things that I would almost recommend is, how can you even add a third party to the process to help you with this due diligence? Because that will help you to be a lot more objective. Anybody, to your point, can get on a webinar and be wowed by the possibility of what's about to happen. But then you have to step out of it objectively and say, okay, so number one, I don't want to assume. Tell me how many of these deals you've brought to completion. Because in the last 3 or 4 years, there's been a lot of people that jumped into the game for the very first time. And they've said, oh, I've got 100 million under management. But guess what? That 100 million has never actually come to completion. That means they don't have actual returns that they have been able to share with the investors, other than maybe the cash flow in the meantime. And so that doesn't give you any sort of track record, even though it sounds like an impressive number, right? The second thing I would say about the operator is this the specific vertical that they've been operating in? Because guess what? Some people went from buying and selling and flipping houses, and now that they're in the apartment game, and this may be their first one, but they can say, I've been a real estate investor for 15 years. Well, that's fantastic. Buying and selling and flipping real estate, a single family real estate home, is a very different business model than owning and operating apartment complexes or mobile home parks or RV parks or whatever the case is. Those things are very different. And so if you don't know what someone's history is in those verticals, you need to be asking that question. And the last thing I would say, there's a lot more questions. And I think, if you're in our mastermind, we've got a due diligence checklist that's like a mile long. But one of the things that you should always be having a red flag is if, number one, they're pushy to get your money. right? They're, hey, you're the last one to get into this deal. Like, we really need you to finish this deal up. Or number two, when you start asking questions, they take something personal, or they get kind of like put off by the fact that you're asking them very detailed questions, almost like they're too prideful. Like, why would you be asking me that? Don't you trust me? The answer is no, I don't trust you. That's why I'm asking you the questions, because I'm about to hand over very valuable dollars to someone who I'm entrusting to steward it well and to grow our wealth together. So this is a business partnership, and it shouldn't be treated lightly for that reason. So a lot more questions about that, Russ, but just to give you kind of a taste of how that should kind of feel, that's what I would do.
Yeah, one of the greatest questions somebody taught me was to ask, how can I lose all of my money and shut up and wait for the response? And then in the past, when things didn't go right and you lost money, how did you handle it? And shut up. Because anybody who's been doing this for long enough have had things go wrong, have lost money. And our measurement can't be on whether or not they are going to always win or versus when they've sometimes lost, but it's how are they going to act when things go bad? Like, that's really what you're trying to find out in operators is I want to be in deals with good people, right? Being in a bad deal with a good person is a good win for me. But being in a good deal or a bad deal with a bad person, no bueno. So you need to understand how people are going to react when things go bad. Will they work tirelessly to get back every dollar possible? Have they filed bankruptcy in the past? Or did they, work for 10 years to pay back all the investors out of the deal that went bad and all the banks that they borrowed money from to ensure that they could do this in the future? Like, that's what you're looking for. You're looking for people who are going to fight for you when things go bad. So asking questions about when things go bad, how did they react? Asking their specific investors how things went when things, like, what are the biggest issues that you wish that this group would improve upon? Like, it should be not on communication. It shouldn't be issues with, timeliness of paying you, right? Like, it's those are the things I want to always have. If you got good communication, they pay you when they say they're going to pay you, then you're going to win with an operator. All right, Ben, look it over here. Just I'm trying to figure out what is the next step that I need to be considering as it relates to syndication. And I think one of them might be around the timeliness of how long money potentially is locked up, right? We have people who are using the infinite banking concept because they wanted liquidity, but now they turn around and they hand this liquidity to a syndicator into a potentially long-term deal. How do people react to that? And what is your kind of wisdom that you give them as they're making those considerations?
Yes, this is such an important part of whenever we're coaching people or talking about this in the masterminds. It's the risk behind this investment, and part of it is the liquidity. Many of you know my background as a military special operations, and I can tell you, I could swear to you that those first two syndication deals that I was a part of, I was like Liam Neeson in that movie Taken. I was like, I will find you. So I literally went to those apartment buildings and put my hand on them, like, okay, this is a real thing. I know that there's an asset here. But as far as the money is concerned, people need to be aware that it's a syndication, which basically means it's a business plan. It's typically formulated as a business, an LLC. And so liquidity is going to be, there isn't any. And if there is, it's a very special consideration. Typically, you can expect your funds to be in this deal for 3, 5. I even have friends doing 10-year syndication deals. And you have to be comfortable with that. If that's not part of your investor buy box, then this is probably not a strategy for you. But we also say, it's a business plan. The the big packet of paper that Joey was mentioning before that tells you all the great things that are going to happen, it may say 3 years, but if the market conditions don't align with that, it could turn into 5 or 7 years. And likewise, if you're expecting that 2x multiplier of your money in 7 years, but market conditions suggest sell today and it's only been 2 years, well, that's something you got to be aware of as well. So that's why it does fit with the IBC and PIOS system, is that we're creating the space for our windfall events. But if it goes awry, we still need our plan to repay our cash value in our policy loan.
Yeah, so I think that quote is something like, but what I do have is a very particular set of skills, as I've acquired for a very long career. Skills that make me a nightmare for people like you.
Something like that.
All right, nailed it.
One of the things that we didn't mention that I think would be important, and you said this at the beginning, Joey, about being active on the front end. That big set of documents that you get, that PPM, and you have all these Reg D filings, and it's just pages upon pages, which is a nightmare for a profile like mine who doesn't even like to see an email with more than 2 sentences in it. But it would be worth your money if you're going to go down this road into the future to learn what's on those pages. So what do? Maybe you find an attorney and you pay them a couple, maybe $1,000 to go through those papers with you to help you understand what is on those papers and why those things are important to you. They'll probably point out things that you need to look for so that the next time, right? Not that you're going to find something specifically in those that are an issue. Maybe you do, and that would be a huge win, right? If you paid $1,000 and it prevented you from making a mistake. I did that. I was buying a car down in Miami. I was going to have it shipped here. I paid $750 to a car shop down there to evaluate it, and the guy got on the phone with me. I was hoping he was going to say, "Sounds great. You should buy it." He said, "You should totally not buy this." And I was like, man, I hated spending $700 something and not even buying the car, but man, it'd been worse to have bought a $30,000 car than $700. So I would say one of the things that you should consider, if this is your first time doing it and you're getting this huge set of documents, pay an attorney on your behalf to just go through those documents with you, show you what's on there and why they're on there. They'll do that for you. They get charged by the hour, probably get somebody for $300 or $400 an hour. So it'd be less of it. Maybe it's 2 hours of their time. You pay them $600. But what they teach you is now you can apply it to every new investment that you're going to do in that area. So then you can go through it and know what you're looking at. Because otherwise, it's just hieroglyphics. I don't know what's on this page. I don't know why it's important to me. That would be a huge area if you want to be active on the front end and figure out how to avoid making mistakes. Become a better investor. Learn what's on the papers. All right, so let's talk about what someone should do next. Mark, in your opinion, who's a syndication maybe best suited for?
Let's go back to time. How much time do you have? Let's take a look at business owners, doctors, entrepreneurs, high income earners who want to invest in, say, for example, real estate, but they don't have the time to actively manage it. They don't have time for tenants, termites, and toilets. If you're looking for cash flow without some of the headaches, I'm not going to say no headaches, because there's definitely going to be probably some challenges that pop up from time to time. Ask me about my investment in 2018 that hasn't paid anything until now. It's definitely not creating a good headspace. So a little bit of head pressure from that. But that could be a fit for you, right? If you don't have the time to go actively acquire property, manage property, look for tenants, you don't have the time to go do some of these other entrepreneurial type skills because you're so focused in your other areas, then maybe syndications could be a fit for you because it is a bit more plug and play.
So, Stallion, you look at our passive income matrix, right? Our investor DNA. Which of the profiles, in your opinion, should really consider not investing in syndications?
Well, I'll tell you, I think it can apply to just about everybody on there, and it could also not apply to everybody on. Like and when we're talking about this tribe, we're talking about the DISC, the DISC profile that we have based that investor DNA off of. But it really comes down to a couple of things. If you need quick access to your money, it doesn't matter what your profile is. This isn't for you, right? Number two, if you're somebody who is highly like, I need to be in control, that would be like your D or even your I profile, or actually I say D and C profile probably need to have some control. Those are going to be people that are probably going to like step away from this or not be as, attracted to it. And then the last thing I would say is, this applies to everybody. If you are being forced to make a quick decision, I would say this is not for you. Do not do it, because that is the one that you look back at and you say, oof, I didn't spend the time. I didn't do the due diligence. I felt this pressure that I was going to miss out on the deal if I didn't jump in right away. And guess what? You're much better off missing a great deal than getting into one that you felt this pressure and now all of a sudden $100,000 is just poof, gone. That's just from having done this a bunch of times. Those are just like the top 3 that I would think about.
Well, let's put this out there. There's a deal of a lifetime comes around twice a week. Let that sit in. A deal of a lifetime comes around twice a week. So there is no deal that you're going to miss out on and just be like, I wish I would have just done that. Like, there's so many opportunities. Now, that's not, a cop-out for you if you're the analytical who's going to want to analyze every single deal, and now you're just going to be sitting here 10 years from now and still no closer to financial freedom because you've never pulled the trigger, right? Like, what I love about the old Colin Powell quote is the 40-70 rule. He needed 40% of the information to at least make the decision, but no more than 70% or he believed the opportunity had passed. So I think we need to apply that in our life, is that we need to be seeing more deals. We need to have good insights before we look at a deal, exactly what is in our buy box as compared to what's not. So for the profile who is not going to do any research on the front end, probably stay away from this, right? Like, get more active. Just be more active. Just find more active deals. The passive deals will probably end up frustrating you because you will make a bad decision more times than not, and those bad decisions will end up costing you. But if you're willing to do some homework, willing to do some research, willing to see a number of deals, then these opportunities become a win for you. So Ben, if someone is interested but doesn't know where to start, what would you say the first step is?
Yeah, the first step is getting crystal clear on your investor DNA. I like syndications. It works with my investor DNA, but to your point, I need someone to back me up on defined details because I just want to run. And so understanding what kind of investor you are and what fits your financial goals is just critical. So we have this in our community. It's something that we coach on all the time and we constantly go back to in our passive income mastermind. But if you're not familiar with it, just DM us in Instagram, put in the DM DNA, that's Delta November Alpha, or visit our website to take it. That's the first step, Russ.
Yeah. Go in there. Joey loves people sliding into the DMs, so it gets you the details. Just making him feel uncomfortable, tribe. All right, well, this has been a great discussion. If you're new to syndications, hopefully this helped you understand how they work, what to look out for, and whether they're a fit for your investor DNA. If you want to dive deeper into all things around passive income, check out our community. Go to whatwallstreet.com and connect with us. We have a free community. We'd love to have you in there. Thanks, Mark, Ben, Joey, for your insights, and we'll see you guys on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.